Hey guys, welcome back. So hopefully at this point you've watched our first lesson, introduction for the Great Depression. Today, Tuesday, we're going to continue looking at the Great Depression and factors that led to really, like I said before, a bad situation becoming worse. Okay, so you should have your Tuesday, March 24th PowerPoint. Okay, and again, as we're going along, if you need to pause the video so you can take your notes, that's fine. No problem there. We can take as much time as you need in this format because you can always pause the video. But let's get going, okay? So our first slide we're looking at today, what is the stock market? Okay, the stock market, really its purpose is to provide businesses with capital they need to grow. So many times companies or startups, right, will go public and they will have what's known as an IPO, or an initial public offering. It's the first chance you have as an individual to buy into a company. Now, technically that means you become a shareholder. You are a part owner, in essence, of the company. Now, the reason companies do this is to build capital, right? If a company wants to expand, they obviously need money to do so. So the stock market is a great way for a small company to raise capital. And it's also a great way for a very large company to remain that very large, powerful company. Okay, now business owners sell portions, like I said, or shares, which, again, if you buy those, that makes you a shareholder. They sell parts of their company to investors by purchasing shares. Now, investors supply money for businesses to expand. Now, as a business owner, this is kind of a double-edged sword, right? Because if you go public, right, you are now beholden to those shareholders, right? You are responsible to them. People don't invest money to lose it. People invest money in the hopes that they will eventually see returns on their investment. Hopefully, great returns on their investment. Right? Think about, for example, if you'd been on the bottom floor of Apple, right, or Microsoft when those companies first started, right, and you look at their share price today, you would be amazed at how much money, how much return you would have gotten on your investment. Now, when all is well and the stock market is booming, that's a wonderful thing. But as we talked about with the Gilded Age in the early 1900s, even though the stock market is rising, those that are tuned in to what's actually happening realize this is much like the Gilded Age. Yes, the stock market is going up and up and up and up and up, but we are really building this system on, in essence, a house of cards, right? And if you just think for yourself, right, you think of a house of cards. If you simply knock away one piece, the whole thing comes down, right? The 1920s are an example of this. Although people are spending exorbitant amounts of money, the system is overly fragile, right? And what we end up seeing at the end of the decade is not at all like what we saw earlier on in the decade. Okay, so moving on to our next slide. The speculative boom and bull markets, right? In fact, we are just coming out of what was the longest bull market in U.S. history. I'm sure you guys have seen, like virtually every other, not only American, but every other individual around the world, our markets are currently taking a beating because of the coronavirus. A lot of people are wondering if this recent bear market is going to lead to a recession. Again, that's to be seen. A recession is where you have two back-to-back quarters of negative economic growth. Okay, so not saying that the virus is going to lead to a recession, But certainly the bear is back. You can't deny that. But before we get to bear markets, let's talk about bull markets. Okay, the stock market boom began innocently enough, as all things do. Businesses thrived in the 1920s, and manufacturers were making products that consumers were eager to purchase. That's a great thing. If you produce something that people want, people are going to buy it. Right? If the demand for your product is there, people are going to buy it. Think, for example, right now, and we're seeing it to the nth degree, literally in our lives right now. If you are a producer of, say, something like toilet paper, or you are a producer of hand sanitizer or cleansing wipes, things like that, your business is exploding, right? Business is good. You have a product that people eagerly desire, that people are yearning for, right? On the other hand, right, we just heard from our governor that all bars and restaurants, things of that nature, rather bars and nightclubs, sorry, not restaurants, but bars and nightclubs will be closed for the next 30 days. Now think about that. That's obviously a product that people are not going to be very eager for. Okay, so where you might be talking about a bullish market and things like toilet paper, you're talking about a much more bearish market in other products. Okay, so people certainly very, very eager to purchase those much needed goods right now. Now, as Americans observed business profits growing, many thought that they could make significant profit, and they were not wrong in thinking that. Right? When consumer confidence is high, people will spend money, right? Which then creates jobs. It then allows producers to produce more, right? Your economy at that point is fully functioning. Money is circulating at a very healthy rate, and business is good. Now, the promise of financial gain drew investors to the stock market, resulting in what is known as a bull market. Now, bull market, think about in the way that, we're going to talk about the bull and the bear, right? A bull with its horns attacks upwards, right? A bull market, okay? That's hence the name. And if you see on your slide there, slide number 3, you'll see that very, very famous bull that you can find in New York. Okay. Now, again, a bull market is where you have a steady rise in stock prices over a long period of time, right? So it's a sudden uptick and then that's not a bull market. We're talking about something that is sustained over time, months, years, so on and so forth. Okay, so moving on to the next slide. Feel free to pause here if you need to. Okay. So an endless boom. Times will always be good, right? Well, we know that's not the case. We know that, yes, good times can last for a very long time even. But nothing lasts forever. This is where kind of greed starts to blind people, right? Their own personal ambition is going to lead people into tough situations financially. They really, truly do become overextended, right? They're investing more than realistically they ought to be, right? Now, many Americans believed there was no upper limit. Again, this is similar to what I talked about in the previous video, the housing market collapse. People believed that the value of their home would always go up. So investing in your home felt like the safest investment you could possibly have. Again, if you think of the value of a product is going to continuously go up, I would invest in that too. And you would be foolish not to, truly. I mean, you would want to invest in a product that is going to have sustained growth over time. That's economics 101. That being said, nothing will continuously rise. And these things that have massive spikes oftentimes crash the hardest, and we're going to talk about a couple historical examples of just that. Okay, now where people, like I said before, had gotten a little overextended, not only were they investing disposable income, right? So income that they had after covering monthly bills, they were investing their savings, okay, in the stock market. So you can already see how this system is going to be in trouble if it collapses, because people aren't going to just lose their disposable income. They're going to lose the money that they had set aside, be it for their retirements, right? Be it for their children. All of that money is going to go away as well. And again, these are the reasons why FDR and his New Deal come along in the 1930s, because so many people did lose everything, right? As our stock market is going through a difficult time right now, people and businesses the world over are losing a lot of money. But many of those safety nets that Franklin Roosevelt proposed and passed, things like FDIC, Social Security, so on and so forth, those programs are still there, right? And they'll always be there, right? The Great Depression, like I said in the previous video, hard times, they're not fun, but they give us opportunities to become better, right? So when we see our stock market right now going through difficult times, be it market correction, be it potential recession, right? Know that some of those safety nets are there that were not there, say, in 1929. Okay, so moving on to the next slide. Buying on margin. Okay, so this would be like, for example, say you had $100 in your pocket, okay, and you wanted to buy something for $1,000. Well, typically that would not happen, right? You would not have the necessary funds to do so. Well, in the 1920s, $100 would go a long way, right? A buyer might pay as little as 10% of the stock price and borrow the other 90% from a broker. Now, a broker was happy to do this because, again, if the market is continuously going up, the 10% that's put forward by the investor, they will make up the remaining 90% from their investments and be able to pay them back with interest. It makes sense if the market continues to go up. If it doesn't, now you're talking about a whole other set of problems. Okay. In this way, like I was saying, someone with $1,000 could buy up to $10,000 worth of shares. Excellent situation if your $1,000 grows to be that $10,000, but what if your $1,000 doesn't grow? Think about the people who invested heavily in the stock market, say in August of 1929. Think about the people who might have invested in the stock market the morning of Black Tuesday. They would have still been able to buy on margin. They would have still been able to purchase shares with only 10% money up front, 90% backed by a broker, and they would have lost everything. And not only would they have lost everything, the broker would have as well. So, we talk about this domino effect. You can see it happening. You can already see it coming because you're building such an unbelievably fragile system. Okay, so next slide. Speculation bubble. Take a good look at the graph there. It helps us understand really kind of the pitfalls that we see with bubbles. Bubbles are inherently problematic because what do bubbles like to do? They like to pop. All bubbles like to pop at some point. Well, the bubble that we are creating in 1929, and really all throughout the 20s, is massive. And everyone has a stake in it. So simple borrowing practices encourage speculation. Speculation is kind of like our futures market, right? Where people are saying, okay, the price of oil is going to go up, so I'm going to buy shares of oil now. Or the price of oil is going to go down, I'm going to sell my shares of oil now. Stock speculators do not necessarily purchase stock to own part of the company, however. We think of all shareholders as being genuinely vested in the benefit of the company. Not the case. Many people that trade stocks simply are purchasing shares because they believe it will make them money. So the morals or ethics or business practices of the company don't really matter as long as the profit margins are adequate. Now, in a speculative market, a company's stock price does not rise because the company is growing, but because speculators want to buy stock today and sell it tomorrow. So there's a problem. The value of the company is going up, but the company's not changing. They're not producing more. They're not hiring more people. So investors get into this tough spot thinking that they've bought this extremely valuable stock, but again, it's that house of cards. They're buying on speculation. They're not buying and trading on something that is tangible, on something that is real. They're trading on bubbles. And again, if you get caught on the bubble and it pops, you could have a problem. Okay, so moving on to the next slide. These are famous bubbles throughout history. One that I always found so interesting was the Tulip Craze. There was a time when people were buying and selling tulip bulbs at nearly $200 per bulb. A flower, $200. People were buying and selling homes with tulips. It was madness. Obviously, even though a tulip is a beautiful flower, no one would deny that, the bubble inevitably burst. And you can see on the graph there the rapid rise, really starting in November, right? And crashing in May. So what is that? We got November, December, January, February, March, April, May. So really, we're talking 8 months. The value of the tulip goes from nothing, spikes to $200 for a single tulip bulb, and then rapidly crashes. Again, if you were on the roller coaster ride on the way up, things were probably very good. You probably made a lot of money. But if you had invested right before the crash, and you're buying and trading tulip bulbs at $150, $200 a piece, and a week later they're worthless, well, you just bought a bunch of flowers for nothing, right? Another example of this is Bitcoin. I know we remember a couple years ago when Bitcoin, not only Bitcoin, but cryptocurrency in general, right? Massive spike in value. Everyone wanted to get in on Bitcoin. And yes, some people did make a ton of money. But a lot of people, when they rode the curve up, did not get off, and it came crashing back down. Okay, so again, these are speculative bubbles. They're not new, and in fact, they're quite common. We've had them all throughout history. Okay, moving on to the next slide. The bear begins to roar to life. Stock market prices peaked on September 30th, 1929. Had they known that, that's the time to get out. But they didn't, again, because they're considering, or rather, not considering, they're assuming at this point. They're assuming that the value is going to continue to go up. Prices would begin to drop after this date. Now, sometimes it might be a very modest drop. Other days it might be a significant drop, right, in the magnitude of what we're seeing today. One instance of these abundant drops, of course, was Black Tuesday. By then, it was evident that the bear market, again, where a bull attacks up, a bear attacks down. Okay, so the bear is back. Now, when the bear comes back, it can be scary times. It is certainly scary times for investors. People tend to spend much less money. in bear markets. It's understandable, right? When we're scared, we kind of move inward, right? We try to protect ourselves. Not surprisingly, then, with it being a bear market, by the end of the year, investors had lost over $30 billion. $30 billion. Now, I know we spent a lot of time talking about the First World War. To put this into perspective, guys, the money that was lost in just this short amount of time was more money than the United States spent in the entire involvement for the First World War. That's the kind of crash we're talking about, right? And we certainly talked about how much the United States invested in the Great War. This was a loss of magnitudes more. So moving on to the next slide. Where your money goes, right? We all have debit cards or things of that nature, checking accounts, whatnot, right? And we have all, at one point, I'm sure, deposited money in a bank. And when you go to the ATM the next day, you can pull out that money again. The thing is, though, that's not actually the money you put in there. I know that's hard to kind of wrap our minds around, right? You would hope that when we put money into the bank, not even necessarily hope, but most people would think that when we put money into the bank, that's where it stays. It doesn't, right? If banks were simply piggy banks, they wouldn't operate the way that we think. They wouldn't be able to loan out money the way that they do, right? When you guys get older and you're trying to get, be it a car loan or a home loan or things like that, maybe even loans for school, the reason banks are able to give that money out, the reason they're able to loan that money is because of the money deposited in the bank. Now, they loan that money with the ability to also charge interest on it, right? That's how a bank makes money. Someone takes a loan, they're going to pay an additional percentage as they are repaying it, right? That's how banks make money. That's how they're able to continue lending out money. Okay. Now, the stock market collapsing is obviously going to affect the ability of banks to give out money. Now, what do you think, what do you imagine banks did when the stock market began to become shaky? Well, they stopped giving loans. This was a tough situation. In our next lesson, we're going to talk about why banks did that, under whose direction, not only the President of the United States, but a group known as the Federal Reserve. The Federal Reserve would restrict the flow of money to the point that not only could people not invest, people simply didn't have money at that point, right? People are going to lose their homes. People are going to lose everything. Right? It's a situation that truly for us today is very, very, very difficult to understand. Okay, moving on to the next slide. A house of cards, right? We should be on slide 10 at this point. Again, at any time, if you need to pause, go ahead and do so. Now, in the 1920s, banks caught the same stock market fever that gripped the entire nation. Previously, bankers only loaned money to businesses and farmers. But that's going to change. Again, if you feel like you can make money, if you feel like the market's going to always be good, now all of a sudden your lending pool is going to expand. In the 1920s, they increasingly provided loans for stock borrowers. So people that are purchasing stocks in speculative bubbles are getting loans from banks. Yeah, you can see where this is going to go. Banks are giving out money, rather lending other people's money for people to have the ability to buy and sell stock. But when the stock becomes worthless, all those individuals who had put money away in the bank, when they go to get their money, it's gone. It's gone. Right? There was a run on the banks, and we're going to talk about that in our next lesson. Now, when the stock market took a nosedive in October of 1929, many investors could not repay the money. Just couldn't do it. Right? It's not that people didn't want to repay their loans. They simply had no money. Okay? Moving on to our next slide. The banking system collapses. As the economy continued to falter in 1930 and 31, large numbers of depositors lost confidence in local banks, resulting in an increase in bank runs. In a typical bank run, panicked depositors lined up around the block to withdraw their cash. Right? Now, fortunately today, we have something known as FDIC, Federal Deposit Insurance Corporation, right? And that means that up to $250,000, the federal government secures your deposited money. This is really a response to these bank runs. People panicked and they went out and they got all the money they could. Very similar to, say, what we see with toilet paper or hand sanitizer. People were panicked, right? And when people are panicked, we've talked about this before in class. When emotion is high, logic is low, right? There were none of these protections at this time. So people panicked. They absolutely panicked. And they had bank runs over and over and over again. Now, just think about this number here. An unprecedented number, 3,800. 3,800 banks failed between 1931 and 32. Typically, what we would see is about 2 per year, 2 banks per year in a local area. 3,800 banks failed across the United States. Okay? This affected millions of people who would witness their savings drying up in an instant. Think about how terrifying that would be. Okay? So, as you're getting to the end here, go ahead and wrap up your notes, guys, and I will see you for our Wednesday lesson, where we will be continuing to talk about the Great Depression, specifically the government's response or lack of response to the Great Depression. Okay? Have a great day.